Good morning. I'm Jim Mintert, Director of the Center for Commercial Agriculture and Professor of Ag Economics here at Purdue. And I want to thank you for joining us this morning for our webinar, The Changing Business Climate for Agriculture and the Outlook for 2015. Joining me on the program today are Chris Hurt, Professor of Ag Economics and Extension Economist here at Purdue, along with Michael Langemeier, who's our Associate Director of the Center for Commercial Agriculture, and Mike Bolge, who's Distinguished Professor of Ag Economics and Extension Economist here at Purdue for many years. So with that, I want to get started, but I do want to point out that we have one additional feature of this morning's webinar, and that is you can call in your questions. We have set up a call-in line, and I've put that number up on the screen for you. We'll be showing that phone number again during the course of the webinar. If you have a question and you want to pose it during the webinar, that's great. We're also going to have a discussion section of the webinar towards the end. And there'll be opportunities to ask questions then as well. But if you have a question, particularly if you want a point of clarification or something during the course of the webinar, we will be monitoring that line as the webinar progresses, and we'll look forward to that as we move forward. And with that, I want to start off here talking a little bit about the changes that we've seen in agriculture. And it's been a dramatic change just over the last few months. And Chris Hurt is going to start us off talking about what are some of the drivers of that big change that we've seen in prices, and looking ahead, the economic outlook for agriculture the next several years.
Well, great, Jim. Thank you very much. And I think one of the things we want to try to do today as we think about outlook is not be thinking in the short run, but really be thinking bigger picture kinds of items. So we're not going to talk so much about short-term decisions on how to store grain or not to store grain, but try to get a perspective of the overall view. This is where we've been, where we're probably going, or at least as we perceive where we're going to go. Now, you've got four economists, so I think that is enough to say we probably won't be able to reach a conclusion, so you'll probably hear some differences as we think about these topics, but that's okay. I think we want to give you some latitude to think as well. So let's start with kind of the general picture, and using Indiana, since we're located here at Purdue, the land grant of Indiana, in terms of crop incomes and animal incomes on farms. And we start on that left-hand visual, looking at the dollars of net profit, if you will, for the cropping sector. And of course, what we see, we'll go back to about the 2004 and 2005 period. That was the last of the $2 corn. And you can see there that incomes, net farm incomes for Indiana farmers on crop production were about $1.3 billion. Now, I probably should mention that these are actually numbers we run because USDA doesn't really split them out by crops and livestock. But let's get that concept about $1.3 billion, that as we got into 10, 11, 12, we see those numbers at least doubling and moving towards tripling of the income. So certainly the crop sector, we would recognize this as a period of probably boom, as most of us would say. Now again, I think one of the really important pieces of information that we can bring, or at least I can bring today, is to think about we're just really right at that point of transition. You know, we hear the statements, well, land values, in some cases, bids are still pretty good on those land values. And what we'd say is there's still some of that cash that is in bank accounts, and not just cash, but liquidity. When that really begins to change is with this 14 crop. As you start to market the 14 crop at the kind of prices we're looking, that cash flow really dwindles the incoming side, and we think many producers may have to rely on some of their other resources. As we look at that 14 calendar year 14, we see the really dropping from the peaks about to half the level of income, and then moving on down in 15 for crop incomes to something like we had with $2 corn. Now again, most people and most agribusiness managers listening today recognize that was very tight margin times. So I think that's where we're headed. That's our best estimate. We look over on the right-hand side, and for Indiana, animals represent about 30% of total receipts. So those bars aren't nearly as high, but note in the past 3, 4, 5 years, some negatives and very low incomes. Now in 14, we see record incomes for the animal sector, and those will be very good in 2015. So one of the things we see is the differential, the cropping sector really tightening up and great opportunities over on the livestock side. As we think about this a little bit longer, we run back over 100 years here and recognize that American agriculture has had periods of boom and then some kind of readjustment. And as we look at this long stretch, what we're looking at here is corn revenue per acre. We're going to adjust that for inflation so we can compare some early 1900s on the left-hand side with more current time periods. And we see those surges, 4 of those surges, and then after those surges, relatively short periods on those surges when we get this into 100+ years of information. And then after the surge, some major readjustments that occur. Just looking at those very quickly, first one around World War I, back in around 1916, 1917, and then moving down as we got into the early 20s to really very low income. So a boom-bust cycle back in that first one exhibited. The second one, we talk more of a boom moderation cycle. That's the World War II and just after World War II. We see the surging coming out of the Depression up to that high in 1946, revenue per acre adjusted for inflation to today's prices, $697. And then falling back closer to the long-term trend line. That long-term trend line, you might think about it as just a long-term cost of production line. Obviously, when we're above that, good returns generally, below it, bad returns, as a general statement. And what we see in the middle of the graph after World War II is a boom and moderation cycle. We didn't go as high, we then had a moderation period, and the strong income growth continuing in the 50s and 60s. Pretty tight times, but still not a bust. Then the 1970s, 1980s boom-bust cycle, and the current one we're in has some feel of that. Certainly, we can feel the boom, the more than doubling, almost tripling of those revenues on average, and now moderation the next several years. Trying to look more at just the big movement up and the movement down. That is the boom period and then the readjustment period, and getting that into focus of how does that look here today. We see the red line is, we're using Indiana corn revenues here on average, and we go back to 2005, that's the last of the $2 corn. And you see revenues on average in Indiana about $425, maybe $430 per acre. Then it was as we started the 06 crop, we really moved prices up quickly. And you can see how quickly red line moved up in terms of revenues per acre. And they're doubling as we got into 2010, 11, 12, 13, or approaching tripling the average revenues. Now what we kind of expect to see, prices can change very quickly. Prices drive the revenue. As prices were driven up in the boom period of strong demand, revenues moved up very quickly. But look at the blue line. The blue line is cost of production as put together by Purdue University's budgets. And what we see is the blue line moved up also, but more slowly. So we have some lagging. The adjustment of costs do move in general, but not as quickly. Now, as we look at the readjustment period over here on the right-hand side, we come down in terms of commodity prices. And what that means is those revenues drop immediately and drop very quickly. But costs, the blue line, are now above the general revenue. And what that suggests is this is really a time of readjustment. Now this goes out to 15, 16, and 17, so that's kind of a hypothesis. But I would characterize this, if you look at where our cost structure was back in, say, 11, 12, 13, probably just as some average numbers, $5 corn, $12 soybeans. Now, as we go into the future, it looks like we're going to be closer to $4 corn and maybe $10 or slightly under $10 soybeans. Now, what does that say? Well, we all wish we could just push corn up $1 and beans $2. But if the marketplace, if the price is going to be at those lower levels, more like $4 and somewhat under 10 on soybeans, that says we have to bring cost down by something around 20%. Now, we don't know how this will all be resolved, but I think that's at least where I'm at. We've got to have cost adjustments as we go into the future.
So, Chris, let me just
Sure.
make a couple of comments here, which I think this chart and the one prior to that, you might slip back there a second.
Sure.
And it's really kind of interesting, two things. Number one is if you look at this longer term history, what you'll find is those boom times are generally periods of, as you indicated, strong demand, a lot of export demand during those boom period of times, generally low interest rates, and a declining value of the dollar. If you look at the history, that is all kind of resulted in some really positive future for agriculture. Now the busts have been exactly the opposite. So demand fell off dramatically, exports particularly. The value of the dollar went up, and interest rates went up.
So where are we today
well,
in those three items?
That's right. That's a great question. The difference between the 50s and the two busts is that we didn't have as much fall off in demand as we did in those two periods of time. So now, to your point, if we kind of think about today, what do we see happening? Well, we see a moderation of the growth in demand. We don't see necessarily a dramatic collapse in demand, either from biofuels or from the livestock sector or for exports. Isn't that right?
Exactly right.
And the second thing is we do see these dollar going up. That's makes us a little nervous, right? But it doesn't seem to be going up too fast, and most people don't think it's going to go up for the next 4 or 5 or 6 years. It's maybe a shorter term adjustment. Interest rates will eventually go up, but they aren't going to go up very fast. That's one reason why I think we could argue that we're going to have more of a soft landing or a moderation rather than the collapse that you saw of the boom of the 30s and the boom of the 70s. Maybe that's more hope than it is, but at least the logic.
Keep our fingers crossed.
That's right.
That's right.
But the other thing that's important on this graph to think about is, and this is kind of the not too good story, or not good news story. You look at the period of times when, in previous periods of time, when we've had the blue line above your trend line, and then you look at the length of the period of time when it's been below the trend line. And what we have agriculture, what we sometimes refer to as a short peak, long trough problem. And what we have, the problem is we build capacity in this industry when there's good prices. We bring land into production, right?
That's right.
And we don't take it out of production when prices go down because of the fixed cost structure of agriculture. Farmers continue to use that land because they will cover their variable cost, right? And so what means that I don't want to be a pessimist, but we need to kind of think about, is this simply an adjustment down that's going to happen for, say, 15 and 16? Then we'll be back to really good incomes again? History would suggest that it probably is going to take a longer term time to get the demand growth to pick up that increased production capacity. We'll be able to build a bigger plant, and we got to absorb that capacity before we're going to get a significant recovery.
Yeah, I think these are really important points, and it's really saying there's vulnerability for the crop production sector.
That's right.
A lot of caution going into this time period that we're looking maybe not just the next year, as you say, but the next 3 to 4 for sure, and perhaps beyond that.
Right. But at the same time, not a collapse like we saw in the 80s. I mean, that's at least
we've a lot of us use the boom moderation, and that means the adjustment. Most people can adjust to it, but they better adjust and start thinking that way very quickly. So great points, Mike. Really appreciate it. Just point out here on the world inventories of corn, soybeans, and wheat at the end of the marketing year. The very bottom line, blue on our screen, is corn. And what we see is that inventories have been building for 3 years. Now, to build inventory, you have to be producing more than you consume each year. We have been producing more than we consumed for the last 3 years. We're building inventory. So those people that say, well, demand is going to grow so fast, supply can't keep up, we have 3 years of evidence now that supply has caught up to that demand growth. So I think that's very important, and obviously the market has gotten that point. Now we do want to point out these yields were very good for corn the last 2 years in the world. This is the world numbers, and soybeans very good this year. So abnormally high yields suggest that prices are depressed, particularly on corn, below what they would be in the longer run. Just looking at some balance sheet numbers here, and then I'll give you some general thoughts on out to 2015 crop. Let's just go to the bottom line, and that is the last two lines of the visual here. The ending stocks rising on corn. USDA has those about 2.1. You know, we think that we'll see somewhat higher yields ultimately for this 14 crop, and we'll see carryouts about 2.2 billion bushels. Now, and prices something in the $3.30 to $3.50 range for this 14 crop. As we look out to 15, returns for corn are very poor. So we're going to guess, both in South America as well as the United States, less corn acreage and more soybean and more wheat acreage. So this gives us the fundamentals to say that if you bring that corn acreage down for 2015, we're looking at my numbers I'm starting out with are 3% less corn acreage for 2015, and you get back to more normal yields, that actually we bring that carryout down some for the 15 crop down to more like a 1.8, and this boosts those prices of corn from the mid $3.50 on up towards the higher $3.75 to $4. As we look out longer term, I'm using for the Farm Bill years 14 through 18 right around $4 corn on average across that time, with actually a few $3.90 or so, but let's just call it $4. On soybeans then, big buildup in soybeans for this 14 crop. USDA has that carryout at $4.50. I increase the yields a little bit for this 14 crop and a little higher carryouts, but around $10 bushel on soybeans. Now we see South America shifting very heavily to soybeans. It looks like USDA is using a 5% increase in South American production this year. And if we see that with higher bean acreage in the United States, beans are in trouble. That $10 level will be closer to $9 as we go into 2015 crop. So I think we've got vulnerability, beans coming down, corn coming up somewhat. Longer term on soybeans, I'm looking at prices of around $10, actually $9.50 to $10 over the next 4 years. Let's stop there. I think that kind of gives us some foundation for moving in, thinking about the long term and what should people be doing. Jim?
All right, let's talk a little bit about the livestock side, because the picture in the livestock arena is much brighter than it is in the crop sector, and really that is the bright spot going forward for the next few years. Let's talk about why that might be true. And I've got a graph up there that shows U.S. red meat and poultry consumption on a per capita basis, and I want to explain what that is for just a second. Those are really production numbers adjusted for the trade flows, meaning exports and imports, and then essentially just dividing through by the population. So it accounts for changes in population over time, but primarily focused on production numbers adjusted for the trade flows. And you can see that as production cost increased in the last 6 or 7 years, and feed cost was the primary growth factor there. The price of corn and soybeans and soybean meal was really the driver there. As those production costs increased, the industry needed to find a way to recapture that increase in production cost. And effectively, the way the industry did it was by putting fewer pounds of meat in front of U.S. consumers on a week-to-week, month-to-month, year-to-year basis. Part of that was changes in production levels domestically. Part of that was changes in trade flows, especially exports. But the key is we put fewer pounds of meat in front of U.S. consumers, and the change was huge. I think it's important to look at those numbers for a second. We were over 220 pounds per capita in 05, 6, and 7. And by the time we got to here in 2014, we're maybe going to be just over 200 pounds per capita. So that's a reduction in per capita meat supply of about 10%. Over a relatively short span of time, and I've only got data on the slide there going back to 1990, but that kind of a drop is essentially unprecedented going back as far as we collect data. So that's a huge change in the livestock sector, And that's what's really driven the strength in all livestock and poultry prices here the last several years. It's this big reduction in supply, and accordingly, we've effectively forced consumers to bid up the prices to obtain the meats that they wanted to consume. What's that mean going forward? Well, we've seen this reduction in supply and correspondingly a tremendous profit period here, especially in the hogs starting at the tail end of 13 and throughout 2014. We're going to start to see some increase show up in terms of production numbers. We saw some evidence of that on the most recent Hogs and Pigs report. Inventories starting to creep up, especially with respect to the breeding herd, and that suggests we're going to see larger slaughter volume as we move through 2015 and continue into 2016. So what's that mean for us? Well, we're going to see larger slaughter and lower prices. We're likely to see hog prices at high enough levels that they're still going to be profitable, not only here in 14, but throughout 15. When you get into 2016, depending on production cost on an individual firm, I think we'll see some disparity there. Some low-cost firms will still be in a profitable position. Some higher-cost firms are going to struggle in that time frame, but still a relatively bright spot in not only the rest of 14, but in 15, with starting to get into some perhaps profit problems in 16. You look at prices, looking at national average base prices. Here in 14, we're going to average over $100 a hundredweight for base prices, starting to drop back in 15, and then dropping back further in 16. And 16 is going to be the year that I think hog farmers are going to perhaps start to struggle just a little bit in response to increases in supplies and lower prices.
But Jim, on this hog as well as the other livestock sector, one of the things that might keep us from having quite the profit challenges that we've had in the past is we don't expect feed grain prices to go up dramatically during this period of time, and therefore their feed costs to go up phenomenally. They will, not at least compared to where they were during the last 3 to 4 years prior to the recent decline.
And that's a good point. The profitability we've experienced here starting in late 13 and obviously in 14 has been driven partly by record high prices on the output side, but also this collapse in feed grain prices, and that's been focused most heavily in the last 3 or 4 months, but that's going to continue to be supportive as we move through 15 and into 16.
And I think in the theme of adjustments going on in agriculture, obviously the animal industry had to readjust from $2 corn, where they were set, to what, $6 or higher corn. And they have done that. And Jim said they did that eventually by making consumers have to pay a lot more for that product. So now they're readjusting to what? Well, that's a lot of what we'd like to know. What's the new price going to be? We don't think it's 6. I think those of us sitting around. We don't think it's 2. So somewhere in between. And readjustment, and that takes multiple years to do that.
Absolutely.
And good point with respect to years, Chris, because I've got cattle slaughter up there, and cattle slaughter is going to be the one that's going to take the longest to respond. It's going to be a long period of time before we see slaughter numbers in cattle rebound. Again, look at the numbers there. Look at 2010, 2011. U.S. slaughter on the commercial basis running around 34 million head. Here in 2014, it's going to be a little over 30 million head. Next year, it's going to go down again. I think it'll go down again in 2016. Because of those long lags we have, it takes a long time to start to rebuild the cattle herd. So slaughter in 15 could be as much as 9% below where it was in 13, and maybe a slightly even smaller slaughter in 16. The first year I could see us seeing any increase in cattle slaughter is actually 2017. Now, one of the things we've talked about earlier with Chris was the fact that over time we are going to see demand for these feed grains catch up, but it's going to take time. And I think this is illustrative of that. We are seeing evidence of increasing interest and expansion in hogs. That's clearly underway in the hog sector. I think if you look at the female slaughter ratio relative to steers, we're starting to see some interest in the cattle sector, but it's going to take a long time for that to materialize. So we're starting to build that demand base for the additional supply of feed grains that we've got out there, but it's going to take a long time for it to catch up. So it's not going to bail us out of the increase in supply that we're facing in, say, in the next year or so. And I think that's a key point as we look ahead. What's that mean for prices? Well, these are prices that I never thought I would put on a graph. I'll be honest with you. They just
changed the axis. Right?
I did in fact had to change the axis.
Did you think you'd have $8 corn at one point either, right?
Yeah, I've lived a long time apparently. But you know, the prices in 14 up 50% in round numbers versus 13. We're going to look at an annual average. These are for Kentucky steers, 5 to 6 weight steers, which are pretty representative prices here in the Eastern Corn Belt. Probably averaging around 225. Next year, I think higher again, probably 250 or better, with prices remaining at that level in 2016. So this is clearly the most profitable period we've ever had in cow-calf production, and people will respond to that. We will see some retention of females. We will see interest in increasing the size of the cow herd over the next several years, but it's going to take quite some time before that materializes in terms of a larger slaughter volume. So just to kind of wrap up, I think the key point is we are going to see a response in this livestock sector. There are some profit opportunities in the livestock sector the next several years, but when you think about the impact on the feed grain balance sheet that Chris was showing a few minutes ago, it's going to take some time before the increase in livestock really starts to have a big impact on that carryover in the corn balance sheet that Chris had up a few minutes ago.
Jim, before we go to some of this issues associated with the input side and land rents, et cetera, I noticed that you did put the profitability of the cow-calf operator up there. You decided apparently that we aren't going to talk about the profitability of the feedlots, having to pay these high prices for these cattle. So would you like to weigh in on that?
Good point. So I took that slide out, in fact, but
I know because I asked you to take it out, but I think we ought to talk about it.
So if you look at cattle feeding returns, again, a little bit like the hog returns that we talked about earlier, cattle feeding returns in 2014 have been phenomenal. Right. And that's even in spite of the fact that we've been ratcheting up those feeder prices and calf prices as we've moved through the course of the calendar year. But Mike's point is that we have, and looking at those prices I had up just a second ago, we have ratcheted up break-even levels in the feedlots to the point where the most optimistic I could get about feedlot profitability in 2015 would be to say that we might break even.
Oh, whoa.
But the reality is, as we move through the course of 2015, there's clearly going to be some risk that some folks are perhaps paying prices for feeder cattle and calves that they would regret later on, right? We're stated another way, and this is not unusual at this stage of a rebuilding phase, and particularly the next couple of years, we're bidding most, if not all, of the profitability in cattle feeding into the price of the calves and feeder cattle. So here in the Eastern Corn Belt, where we're more heavily focused on cow-calf production and feeder cattle production, this is good news. If you're a Great Plains cattle feeder, these could be some challenging times. Not so much here in 14. I think it'll actually be perhaps later into 15 when we see some losses accrue in the feedlot sector. That would certainly be a concern anyway going forward.
And we're going to come back to this at the end of this when we start talking a little bit about strategies and later on in some of the other sessions. But here's a good example, it seems to me, not unlike the grain sector. If you pay too much cash rent, your costs can't come down very fast, right? If you pay
too much for land.
Yeah, or too much for land. If you pay too much for the feeder cattle, and so farmers, it seems to me, as they think about trying to position for this new business climate, have to really work harder on their cost structure and thinking about whether, in fact, they can afford to pay as much as as these prices would suggest, or whether they bid all the profit potential out of that cattle operation, just like on the land. So buying inputs is a really, really important. I sometimes say the first and most important marketing decision a farmer makes is not what he sells his crop for, but what he pays for his inputs, because that sets his cost structure. And it's going to be really important for the cattle industry as well as for the crop industry.
Yeah, and that's a good point throughout agriculture. We're entering an era where we're going to have to pay more attention to that than we did the last several years, especially on the crop side.
We're going to have to do it again. That's the norm, as Mike reminded us. If you look at those 30-year cycles, the boom period is only around 10 years. The downside is 20 years. So he mentioned that as a short peak and a long trough. So that's the norm. That is the norm. You would expect in the long run that you're going to be a very commodity-oriented, low-cost kind of business.
Our challenge in agriculture is that after 5 or 6 years of very positive returns, we sometimes forget the norm fairly quickly, and that's human nature.
Oh, I thought it was a new norm. I thought, yeah.
That's human nature. Whether you're talking about agriculture or the stock market, whatever, we tend to have short memories, and I guess that's our challenge today.
So Michael's going to actually tell us that these costs are going to collapse just immediately, right? That's what he's going to tell us. Not quite.
Not quite.
Not quite.
Please bring it down.
Yeah.
Let's shift gears here and look at earnings per acre, and that'll lead us into a discussion or debate, if you will, on cash rents and land values. Hopefully we'll have some lively discussion on where cash rents and land values are going. And so let's go back to a graph that's similar to what Chris was showing earlier. This doesn't show total cost, this shows variable cost, and so I do not have the overhead costs associated with labor, cash rent, or machinery ownership costs in this red line. So keep that in mind when you're looking at this graph. It does differ from what Chris showed earlier, but obviously 2011 we had gross income over $1,000 per acre. Look at 2014, we're down to 600. It's probably going to stay 625 or so, like what Chris was indicating, as we look into 15 and 16, unless prices somehow change from what Chris was talking about. If we look at the blue line, that's the contribution margin. That's your return over variable costs, and so that amount has to cover these overhead costs associated with labor, machinery, ownership costs, and cash rent. You can see for corn in 2014, that's only $200. That doesn't even cover cash rent in most cases, and so obviously we have some negative margins here in corn in 14 already, and that will continue into 15, as I'll show you on a slide here. Soybeans is a little different story if we look at the last 2 or 3 years. Market revenue in soybeans never got near as high, of course, as corn, but it was up there close to $700, and now it's dropped to $500. That drops our contribution margin down from about $450 down to about $300. But soybean contribution margin in 13 and 14 was actually higher than the contribution margin for corn in 13 and 14. That's a different story than we saw from 2007 to 2012. From 2007 to 2012, corn was very competitive, compared to soybeans. That's switched here in the last year or two, and we'll see how that plays out in the future here with the potential for lower prices for soybeans. But certainly the last 2 years, soybeans have been more competitive.
And really, what that's reflecting, what you just said, corn was the driver for so many years. The big growth in corn use for ethanol mandated by Congress was from the 2006 to the 2010 crops. That was the big surge. After 2010, we've been pretty flat, around 5 billion bushels of corn use. I think a lot of producers didn't catch up with that for a year or two on into 11 and 12, and now we have seen beans look much better.
And I think this chart here shows that very clearly. The little triangle or diamond there is the soybean margins from 2005 to 2014. The bar is corn, and you can see from 7, 8, 11, and 12 in particular, corn margin was substantially higher. As we moved to 13 and 14 here, soybeans were higher. We actually had a pretty good margin in 13 for soybeans. In 14, obviously, both of them are negative margins. We're not able to cover all of our overhead costs, but corn is much more negative than soybeans, to the tune of over $100. And so certainly that lends itself to what Chris was talking about earlier, a reduction in corn acres replaced with soybean acres because of this differential in margin. Notice that's for 2 years in a row here. This is not just something that's happened recently. And so I think it's very important to take a look at this drop in margin. Look at that corn margin. I don't want to dwell on this too much because it can be a bit depressing, but a $200 drop in 1 year, that's large. Break even in 13 and then down to about negative $200 per acre in 14. And this includes some government payments. I'm anticipating some government payments coming out of the ARC and PLC program. My forecasts are included in these estimates, and so even with those, it looks fairly grim.
So Michael, how much government payments roughly have you got built into that?
I've built in about $40. They could be higher than that. They could be up to $75. I've built in a fairly conservative number. I believe the number I have is actually $45 built into these charts.
And I don't recall, Michael, are you going to say anything about 15 here in terms of whether this relationship is going to stay in terms of the margins?
I don't have it on this chart, but 15 looks a little bit better because I'm using a slightly higher price in 15 compared to 14. The cost structure is about flat.
Yeah.
You know, if we assume cash rent doesn't
Yeah,
decline,
yeah,
we're getting into that next.
yeah,
But if we assume a similar cash rent, we're looking at slightly better margins. But what the slightly is the key here.
Yeah.
And maybe less negative is
Yeah,
on
less
this visual.
negative.
Yeah.
But beans and corn do correct some.
Yes.
You know,
Correct
you expect
some,
that
okay.
corn price to come up, beans to come down.
Yeah, the
and
difference
that
is not
differential to
$100
correct.
in 15. It's maybe closer to 50.
Yeah. Okay.
Yeah.
Okay.
And just as a point to made there, Michael, if you go back to the middle of September when Karine Alexander and I did a webinar, that margin, that spread between expected returns between corn and soybeans was quite a bit wider. So the market has already reflected that, and effectively what's going on there is the market is trying to encourage people to shift away from corn towards soybeans, and we're seeing that take place, and we're probably going to see some more of that over the course of the
As
winter.
South America, the acreage goes to beans, and then if there needs to be more adjustment, that's going to be U.S. farmers making the decision, more beans next summer. So I think by the next spring, we're going to have corn and bean prices back in equilibrium.
Yeah. The other issue here is, I think, again, under the government program, beans don't get much payment under the government program, right? So maybe a sum of this is the fact that you get a government payment on corn, not on beans.
That's true, Mike, but the payments are based on base acres.
Yeah, I understand. But what I'm
you're
saying,
right. No,
yeah,
corn is much more likely to get a payment than soybeans.
Yeah, that's right.
Yeah.
That's right.
But budgeted operating returns right now for corn are much lower. So when you put them together, it's still saying, you know,
Right.
Less corn next year.
Yep. Right. Good.
And even with $4, I mean, we could talk about break-even prices a little bit, but break-even prices for corn, if you're looking for 2015, are still $4.50, if not $4.60.
Okay.
And so even if we get to that $3.75, an increase from your $3.40, $3.50 forecast, you're still way below break-even on corn, and not quite as bad for soybeans, but you're still below break-even on soybeans. And so that negative margins, looking at the futures prices and our projections, that's going to hold for 15 and 16.
And we talked about 05. There's $2 corn back there. And look at the margins in 14. It's kind of similar to where we started before the boom.
Yep, that's right. That's right. Yep.
Let's look at cash rents and land prices, and that'll lead us into a discussion of where these may be heading. Just a note here from 2005 to 2014, looking at the last 10 years, cash rents doubled. This is for West Central Indiana. Using our Purdue survey information, cash rents doubled, land values tripled. Let me restate that. Cash rent doubled, land values tripled. And so to expect there not to be some correction would be a little bit naive, because our increases have been so rapid from 2005, particularly from 2007 on. And so we're certainly expecting some correction here. But I would like to point out that a drop of 10% in cash rent, if you look at a 50-year history, a drop of 10% in one particular year is a very large drop. I don't have a graph of that, but if you look at the last 50 years, from 1960 on, so more than 50 years, there's only been 3 years where cash rent has dropped 10% in a particular year, and it was right at 10%. And so let's put this in perspective. Even though margins for corn are $200 down, we're not expecting cash rents to plummet. What we would expect is maybe a 5 to 10% correction in cash rents in land values in each of the next 2 or 3 years. That would be a more realistic expectation if we stay down to $3.50, $3.75, $4 corn, is to see a correction take place over time. One of the reasons why the correction is slow is we have to realize that not all rents are annual. And so we do have some longer-term contracts out there, and so cash rents do tend to come down slowly. But also some people may be thinking that the new norm is going to return, and so they don't want to drop cash rents too much in a particular year and then have to increase them again 2 years from now. And so I think it's very important to point out, even though margins are much lower, we're probably looking at fairly small drops in cash rent over the next 2-3 years rather than a collapse. Let's look at some factors impacting land values after this slide, I guess. This shows farm price to cash rent. This just illustrates that farmland increased faster than cash rent. That's one of the things that this graph illustrates. It also illustrates that the lower interest rates were built into land. We've had historically low interest rates. You'd have to go back to the 1950s to see interest rates similar in nominal terms to what we've seen recently. And so I think the combination of some very good returns and low interest rates caused a situation where we were bidding up land to a fairly large degree. And that's what this is showing right here. Very high multiple farmland price to cash rent historically.
Before you leave that chart, it is really, I think, something to kind of look at least put in perspective the relationship between the value or price for land and its rent. This is a multiple, Michael, that is used in all the financial markets is the PE ratio. And you got there the red line, which indicates that it's averaged here about 18. Actually, if you look at stock prices, they run about in that same space,
about
right?
20 over this similar
20.
period,
That's
about
right.
20.
That's right. And so if you think about land from an investment perspective, it's not all that differently historically priced compared to stocks, et cetera. Now, what to me, when I look at this chart, there's a couple of things that are interesting. One is we saw the boom of the 1970s. What happened to that PE ratio? It went up dramatically, but didn't go up, never got above 22, right? Went down into that 10 or 12 space here in the 1980s, the very bad period of time. I don't know. It looks to me like it ran away from us there recently, right? Up to 32.
I think there was just a lot of optimism that the high margins were here to stay and the low interest rates. That was a deadly combination, if you will.
That's right.
When you're looking at the PE ratio.
Yeah.
And one reason I argue is that there was excessive talk about demand. You know, we've had studies done out to 2050, how many people, growing incomes, that we can't keep up with that demand growth. Right. And I think what we see in agriculture is if you have a demand surge, history tells us supply ultimately, it may take several years, but ultimately supply catches up. I think that's what we're saying. Supply has caught up.
In fact, Chris, I think you've got some numbers, 170 million additional acres of land brought into production in the world in the last 9 years.
Which represents about half of the U.S. crop base around the world, new acres.
Or double the typical corn acreage that we've been producing here in the U.S.
That's correct.
During that period of time.
Right.
Wow.
So we've got a lot of production capacity that's been brought in.
I keep saying, don't believe the myth. They ain't making any more of it.
Well,
we do, in fact, under the right price scenario, bring land into production, and there's still land that could be brought into production with the right prices.
And when we get a chance to teach economics, we have this demand curve on a graph, and that's all that's been talked about. A lot of agribusinesses, growth. Right. We always put a supply curve on there too. So you've got to talk about both supply and demand. And I think that's what's missing.
That's right.
But to get back to the point that I think Mike raised earlier with respect to the boom-bust scenarios that we've experienced in agriculture for the last 100 years or so, the previous bust were characterized by supply growth combined with some kind of a collapse in demand and perhaps also an increase in interest rates. And it looks to me like we've really got a scenario here where we're making a pretty good case for there being one of those components, the supply growth, but not the other components. And that, I think, is very big in terms of what's likely to happen the next 3 to 5 years. So we might talk more about that here in a couple minutes.
That's a very important point, Jim, and I think that's why when I say a drop of 15 to 25% in cash rents and land values, that sounds really big. I consider that a soft landing, quite frankly, given where cash rents and land values have went, how fast they've increased in the last 10 years. I consider that a soft landing. It certainly could be much worse if we had something, some drop in demand.
Well, some of that will depend on what happens to these variable input costs too. If they could adjust, if somehow you could cut the variable cost, if. So I think that's ripe for discussion as well. Then land wouldn't have to adjust as much if we could get variable costs down.
That's right. That's right.
Let's look at one more slide related to land values, then we can maybe go into input prices and some other topics. Factors impacting land values, these are the main factors: cash rent and the capitalization rate. Cash rent, if you look at cash rent historically, statistically, it's based on previous cash rent. So cash rent tends to follow the values that occurred in the recent past, but also on net return to land and management. So net return to land and management has dropped $200 per acre on corn, for example, and so that's certainly negative for land values. But also I wanted to point out with this slide that there's also a lot of negatives on the capitalization rate side. U.S. Treasury rates are expected to increase, maybe not immediately, but maybe sometime in the next 3 to 5 years. 2% would be a relatively small increase. They could increase 4%. Inflation also has been relatively low recently. There's also a chance that could increase. That would cause a different situation on capitalization rate. That would be negative for land values. Also, the risk premium. That's the difference in the agriculture interest rate and U.S. Treasury. You'd expect, as we go into lower margin period, more volatility in the agriculture sector, that the risk premium between agriculture interest rates and the U.S. Treasury rate is going to increase. And so I also expect that to be fairly negative for land values. And so in summary here, there's basically 4 things that are negative on this slide for land values. Net return to land and management, U.S. Treasuries are going in the wrong direction, inflation's going in the wrong direction, and the risk premium's going in the wrong direction. So that's why I say that this 15 to 25% drop in land value is, I think, quite likely.
So Michael, I think an interesting question here on this capitalization rate discussion is that in a way, it doesn't sound like a 2% or 200 basis point increase in, say, the interest rate as a function of the drivers you've mentioned there, the U.S. Treasury, the fundamental cost of money, risk premium, et cetera. What's really important to remember is that's off of a 3% or 4% base,
yes.
Right? And so the amount of increase, the percentage, I tell a lot of farmers and bankers, doesn't sound like a big number, except when you put it in a percentage term, it's a big number.
Even a 1% change would be a big number.
And even a 1, that's exactly the point. Even a 1% change, even if it isn't quite as big as what you're suggesting, a 1% change on a cap rate of 3 is what? A 30% increase, right?
Yeah.
And so we've got our rates down so low here that you don't have to have much upward adjustment. And I don't think there's very many people that believe it's going to continue to go down.
Yeah.
It is going to go up slowly.
Yeah.
But even a 100 basis point increase, even if it's slow, is a large percentage increase. And has a big impact.
And I would contend, along with your point, Mike, that there's more danger or downside with respect to the capitalization rate than there is with respect to cash rent and net return to land and management, for exactly the reasons you're talking about. We are at extremely low interest rates, and so any return to a long run average is going to be very detrimental for all asset prices, including land.
So I want to follow up on that for just a second, because going back not quite a year ago, we collectively thought that interest rates would be rising during 2014, and that has not been the case. But I think from a management standpoint, our recommendation is still the same, and that is going to be to go ahead and lock in these current rates, because even where we've seen some declines in interest rates have been very, very small, and in some cases really not reflected in the agricultural markets and the ag credit markets. So the real thing you want to manage against is this risk of rates going up over the next, you said 3 to 5 years. I would say even a little longer than that. If you think about a longer term horizon, the odds of locking in rates at current levels being a bad decision 5, 7, 10 years from now are very low. I mean, I think from a management standpoint, even if we don't see a return of inflation, and there is some discussion in the economic circles about the risk of deflation. The odds of this being a bad management strategy are very low. It might turn out that the rates don't go up as much as perhaps we currently think is likely, but you would still lock in rates at very attractive levels.
Yeah, and just a couple of things to elaborate on that in a second. This point of deflation, there is more concern about that actually in the EU and in Europe than there is in the U.S. The deflation issue is not quite as big an issue here in the U.S. But what is a concern, to your point, is that, or what has happened is interest rates have not gone up as much as many people thought, although the Treasury rates went up, but then they fell back down, right? And the reason for that is not good news. The not good news is that the economy does not appear to be recovering as fast as the Fed would like it to recover. And the markets are not recovering as fast. And so it's kind of one of those things, well, the good news is that they're not going down, well, not going up. Well, that's really the bad news because the demand side isn't as strong as we'd like to have it, right? And so we do need to recognize that maybe it's good for agriculture that interest rates haven't gone up very much, and that it's not good in the sense that that's a reflection that the economy, particularly the domestic economy, as well as the world economy, is showing slower economic growth.
And as we were talking about this same topic last year, we were expecting quantitative easing maybe to stop sooner. And because the economy has not has recovered as strongly as they thought it was going to be, that hasn't unwinded as much as we thought it was going to. And so I think that's key. That's a key factor in what's happened to interest rates in the last year.
I just want to throw in, over time, rising interest rates. I think we all agree on that. When, we don't know, but rising interest rates are one of the factors that could drive the dollar higher as well. If those U.S. rates rise relative to world. And you've already mentioned, Mike, that a rising dollar could hurt us on commodity prices. And boy, we see oil much different too.
Yep, that's right.
And so I think all these things are kind of fitting together to say commodity prices are actually under some, have some ceiling, I think.
That's right, they're under pressure.
Maybe they're not under downward pressure, but there's kind of a ceiling.
That's right, certainly some ceiling potential on them. Yep. Just quickly before we kind of go to a little bit of strategy stuff, what about the input costs here, Michael, in terms of fertilizer, seed, and chemicals? We've already hinted that it's going to be tough for them to adjust down. You said land rents generally don't adjust down very rapidly. Is there any evidence that we're going to see much adjustment down on fertilizer, seed, and chemical costs?
There's quite a bit of uncertainty there, of course, like there always is, but maybe more so this year. I think seed prices, if you look at the last 40 years, seed prices have increased 4.5% on average per year since 1973, using USDA data. Certainly, I would expect it to be much lower than that this year. Maybe closer to 0 to 1%, unless it's a new hybrid or something like that. And so I think a much smaller increase in seed prices. Fertilizer is a little bit uncertain right now. If you look at nitrogen prices right now compared to last fall, they're actually slightly higher. You know, given the drop in oil prices, it's a little bit uncertain whether that's going to what's going to happen to those as we move into the spring. And so there could be certainly could be some downside in fertilizer prices.
Now, the one thing on the cost side, although it doesn't give us much relief in terms of the overall cost structure, but certainly in terms of the cash cost side, farmers have bought a lot of machinery over the last 2 or 3 years. And so they aren't necessarily going to have to buy a lot of machinery this year. So from a cash perspective, in terms of cash flow, that at least gives them some cushion that they maybe, it's not like we might have been in the past where I didn't buy machinery, I have to replace the planter, I have to replace the combine because it's just wearing out. Some farmers in situation, but that's not typical of what we see out there. So farmers have got some cushion here for maybe the next 2 or 3 years in terms of not having to make capital expenditures. Not good news for that machinery dealer, right? Or the machinery manufacturer, but at least it takes some of the financial pressure off that farm in terms of having to put cash out to buy a replacement planter, combine, tractor, et cetera.
Yeah, the combination of very strong margins for crop producers and very good or beneficial depreciation rules, tax rules, was a perfect combination to buy quite a bit of machinery, and so because of that, we shouldn't have to buy very much, as you indicated, in the next 3 to 5 years.
Yep.
Let's turn our attention to some strategy issues, Mike, and we've painted a scenario or a picture of an economy that's undergoing and to some extent already undergone a big change. And I think the key for a lot of people is to think about, all right, how can I position my business for success in this new climate that we're facing in agriculture? So let's talk a little bit about some of those strategies. We've outlined some of them on the slide. Let's walk through some of those and how people might actually implement those on their operation.
Yeah, so let's kind of make sure that we only have about 5 or 6 minutes left, so we're not going to be able to talk about all these in detail. And Jim, that's exactly where we're going to go with future seminars, is to have more detail on each one of these. And all we're really trying to do at this stage is tease them up and kind of say, okay, these are the things that ought to be on your radar screen, and we'll have time in future webinars to talk in more detail about them. But probably the first thing that everybody talks about in this kind of business climate is protecting your working capital. Working capital is the difference between your current assets and your current liabilities. It's the cushion that you've got in the business financially to be able to take advantage of good times when they do reappear, or asset purchases that you might need to make, but also to buffer you from those losses that you might incur. It's what allows you to actually be able to meet the cash flow and buy the inputs, even though you didn't make money for last year. At least you got the money to left from selling your inventory or excess cash to be able to buy the fertilizer, seed, and chemicals for the next crop, make the payments, etc. It's really important to protect that working capital. Here's the concern I have. Machinery dealers, as we've already said, are under real pressure. They've got too much used equipment. In the next 2 months, they are going to give farmers deals they have never seen in their life to buy that used combine. A 1-year-old combine with a full warranty, which is what's now available. No hours on it. And they're going to be willing to sell that combine for a 30, 40, I've even heard some people saying even more discount. Farmers are going to be so tempted to buy that. And here's the issue. If you got lots of working capital and you really need it, that's one thing. If you're going to have to destroy your working capital to do it, that's going to be a tough decision. But you need to seriously think about saying no in that situation. We've destroyed a lot of working capital in agriculture by paying cash for land, by buying machinery with cash, and we have to make sure that we protect what working capital we've got left. So number one thing, working capital is the first line of defense against financial stress. We got to protect our working capital. Not unrelated to that is hold on to your cash position, as we've indicated. And you may also want to restructure debt. We have actually, the money we've borrowed in agriculture for capital expenditures has been bought on a very short repayment schedule compared to history. So we bought a lot of farmland, borrowed money on a 10-year payout. Typically, we borrow money on farmland for 20-year payout, right? We even used to have 30-year loans on land. We went back to 20. 10 years is a short period of time to be able to pay that off. Now, we could when we had the good incomes of the past. But if we don't have those incomes, you're going to find some farmers are going to encounter repayment problems. Machinery. Bought a lot of machinery. If we borrowed money for 3- and 5-year payout, normally we go 5 to 7. So we've shortened those repayment schedules over the last 3 or 4 years, and we need to really seriously think about lengthening them out. Now, I would tell you that lenders get nervous about this if, in fact, when you propose to do that is when you can't make the payment. They really get nervous. You need to be preemptive on this. We need to go talk to our lender and say, we could make our payment this year, but you know, if this continues, we may have trouble next year. Let's get this restructured now rather than wait until. And if the lender doesn't, the lender now has a new person to report to in the lending institution called the risk officer, the chief risk officer. And the chief risk officer has a tendency to say, if it's a problem, no. If it's preemptive, we'll think about it. If it's a problem, no. And so we need to recognize that we're in a different business climate in that context as well.
So Mike, looking at the 5 points you've got on the slide there, those first 2 are things that I don't think, we can't overemphasize the importance of protecting working capital right now.
That's right.
Starting today, if you haven't already moved in this area.
Exactly.
And the second one is, if you're in a position, as Mike just described, with respect to you purchased farmland or another asset on a relatively short repayment schedule, restructure that debt immediately.
Right.
Don't wait.
Don't wait.
Those are things you should be doing now, between now and Christmas.
That's right. That's right. That's right.
Some of the other things, maybe a little longer term,
That's
those 2 are ones that you should be paying attention to right now.
That's absolutely true. Absolutely true.
And also fits right now, when you start to sell the 14 crop, that's when the positive cash flow turns negative.
That's right.
It's right now.
That's right.
So,
exactly.
Great.
Exactly.
This is the time.
So just a couple other here, and then we're running out of time. So you always need to worry about trying to make sure you're fully utilizing your assets. Well, you know, what if we aren't? I mean, that's the tough thing that a farmer who's renting a lot of land has got to worry about. Do I give up that land and park some of my machinery if I have to pay this premium cash rent? Or do I pay that cash rent recognizing that I'm probably going to lose money, but I want to do that because when prices do improve, I don't have to worry about bidding it back in or never getting it back at all. It's a real tough issue, but asset utilization is really, really critical at this point. Buying right, we've already mentioned that. What you pay for your inputs sets your cost structure. And in the long run, in a commodity industry, those that are successful are low-cost producers. I mean, it isn't rocket science. And if you lock yourself into a high cost structure, you just really have a hard time getting out from under that problem, whether it be in terms of improving your yields or trying to sell your crop at a higher price. It's really tough. The final one here real quickly, and we'll get into all these in a lot more detail, is that farmers have got just a little bit lethargic, Jim, on how they kind of run their business. When you got $2 or $3 margins per bushel, profit per bushel, you maybe do some things a little less effectively and efficiently than you might otherwise. You maybe buy some inputs that you may not necessarily say, well, I'll buy it because I think it's going to work, but you know, if it doesn't, it's not a big problem. I still got lots of profit left. What we suggest you do is, you know, I mean, to Chris's point, 10 years of not such good times, or maybe even 20 years in the past, farmers know how to do this. They know how to run their business with focus on cost control. Dust off that old playbook, bring it out, figure out how to do everything. I mean, you got to do everything today with a focus on reducing your cost structure. Everything you do, whether it be in terms of purchasing decisions, whether it be in terms of efficiency, whether it be in terms of scheduling, et cetera. But the issue you have to be recognized is that in a global market, that farmer in Ukraine woke up 6 hours earlier than you did and got a head start on you, right? And that's really true because we're competing with that Ukrainian farmer, okay? So better execution, and here's the good thing about better execution. Let's assume for a second that things improve more than we think they're going to, faster than we think they're going to. That just means if you have better executed and a lower cost, you're just going to make that much more money than you would have otherwise. So it's a win-win in terms of just figuring out how to do everything you do more efficiently, more effectively, and better.
And I think to take that one step further, Mike, it really positions you to take advantage of opportunities that might show up. And we talk a lot about the 80s. One of the things that we maybe tend to underemphasize for the 80s is that people that were pursuing these kind of strategies at the beginning of the 80s were positioned for success during the 80s and were able to take advantage.
Absolutely.
And you can look around your neighborhood, and perhaps you were that individual that took advantage of some opportunities that came up during the 1980s if you were positioned for it. And so I think if you pursue these kinds of strategies, you might be that operation that comes through this very well.
Absolutely, absolutely.
So let me wrap this up, and we'll take a few questions if we have some online. Mike mentioned that we are going to have some more webinars and really talk more about some of the things that we've outlined on this slide in more detail, some strategies, some things to think about and doing in terms of managing your business more effectively in this new environment. The next webinar will be on November 21.
And actually that's going to be on something that's not on the list. It's going to be making sure you're participating in the farm policy, taking advantage of the safety net, right?
Yeah, we're going to talk a little bit more about farm policy, in particular maybe some emphasis on how you can use the decision tools and walk through and think about how those decision tools can best be used on your operation to help you make the decisions you need to make with respect to the Farm Bill. So that'll be on November 21. Same time slot, and of course if you're watching this, you should be on our database and should get an email from us letting you know more details about that. Then we plan to offer a series of webinars during the rest of the winter. So we've got webinars slated for December, January, I think February, and even early March on a variety of topics that will help you position your business for success over the course of not only 15 but really the next several years. So keep in mind that those webinars are coming down the pike. You'll get emails from us if you're in our database, and you can always check on our website, which is just the Center for Commercial Ag. If you type that into your search engine, you should pop up very quickly and on number 1 and click on it and check it out that way. So those are a couple of things coming up. One other thing on the farm policy arena I want to mention, and the Center for Commercial Agriculture, Purdue Extension is partnering with the Indiana Farm Service Agency, Indiana Farm Bureau, the Indiana Soybean Alliance, the Indiana State Department of Agriculture, and the Indiana Corn Marketing Council on a series of Farm Bill meetings in December and January. And we'll have, I think, 3 meetings the first week of December, first full week of December. We'll have 3 meetings the first full week of January as well. I think our very first meeting is going to be on December 8th, in fact. So there'll be more information coming out of that here probably next week. That information will be on our website, but those will be half-day meetings that will really enable you to get a better grip on especially some of the details of the Farm Bill and maybe how you can better use the tools that are out there to make some better decisions on your farm operations. So look for those. Those will be in-person meetings scattered around the state at, I think we have a total of 7 meetings planned, and they're going to be all over the state. So keep those in mind, and we'll have more information coming out of those very soon. And with that, I want to see if perhaps we might have a question from the field. I know I could hear that were a few people that had used the phone link. So if there is a question from the field, we'd like to try and address that right now. So while we're wrapping up, I guess, one of the things that I think about the message going forward, and one of the things that we could talk about with respect to taking some action, we talked a little bit about this relationship between corn and soybean prices. If you're a farmer that's thinking about changing your crop mix a little bit, maybe you're that farm operation that's been skewed more heavily towards corn and a little less towards soybeans, and you're looking at these projected better margins in soybeans right now. If you're thinking about switching some of that acreage to soybeans for 15, Chris, is this a good time to be locking in some of those prices on the soybean side especially?
Well, I think it is. And again, what we're looking at is soybeans are very high priced relative to these other crops. And that suggests over time you're going to get some downward pressure on soybeans. Now, the counter to that has been going on the last 3 weeks. China has been buying lots of soybeans. So China is the big player in the world market on soybeans. Nobody really ever knows just how big a buyer they're going to be. So markets right now have that enthusiasm build up. China buying beans aggressively. And kind of what happened, we got down to $9 on futures, and guess what? China said, that's the low, I'm going to buy. When your biggest buyer says that's the low, a lot of other followers in the market say, if the big buyer's on board on the upside, we want to be. Second thing on the beans nearby that, and so I'm in favor of selling beans right now, has been soybean meal. We had the late harvest and soybean meal was gone. So we have seen this surge in soybean meal the last couple of weeks. That is also driving the beans. Beans have been the leader. I think that is about done for the short term. We're going to come down on bean prices.
And what's the southern crop, South American crop looking like in terms of coming up?
Well, again,
rainfall
it was
there.
very dry in that early October time period, and that was giving us some strength, but now that's largely resolved itself.
Yep.
And that looks good. We're talking 5% higher production is USDA's number out of South America.
Right.
They're the big producers in the world now.
Yep. And the Chinese could go there.
Well, that's right. China will go both places because they have to.
Yeah,
they buy so much.
That's right. Absolutely. Absolutely. Yep.
All right, with that, I think we've maybe exceeded our time limit by just a bit. So if you have some further questions, don't hesitate to email one of us. My email is jmintert@purdue.edu, and I'd be would welcome any emails from you and comments, questions, etc. And with that, I'm going to wrap up today's webinar. Thanks for joining us. And so on behalf of the Center for Commercial Agriculture, have a good rest of the harvest and a good day. Thank you very much.